Introduction to Retirement Plans.
We're going to talk about retirement plans in general first. Business owners have a lot more choices in order to set up retirement plans for themselves and their employees. Anyone can set up a traditional IRA or a Roth IRA. You don't have to own a business. You can just have wages. As long as you have qualifying compensation from basically any source, you can have a traditional IRA or a Roth IRA. You just have to have earned income. But business owners specifically are allowed a lot more choices with regards to retirement plans. And this is actually true even if you work for an employer, have a retirement plan through that employer, and also maybe have a side gig or a side business for yourself. You can have both. It's possible for you to have like a traditional pension at your regular job, and then also have an additional retirement plan for your business that you have. If you have like a side business or a part-time business, that's possible. And I'll tell you, when people are younger, they don't think about this very much. That's been my experience. But right around 50, 55, that's when we start to get a lot more questions as tax professionals about retirement and funding retirement. And people start to really want to max out their retirement as they get older. They want to put as much into savings as they can. They know that their retirement age is coming, and they want to try to be maxing out as much as they can. They want to do retirement planning. And you will notice, as a tax professional, as your clients get older, they will have more and more questions about retirement plans and future retirement planning and financial planning for their future. As they get older, they get more and more concerned about this. And many tax professionals are also retirement planners. They offer both services to their client base. So this is actually something that's useful to know about if you want to increase, your practice model. You can offer tax planning services as well as financial planning services to businesses and individuals as part of your practice. Employers may establish retirement plans as fringe benefits for their employees. Self-employed taxpayers are also allowed to set up retirement plans for themselves. So you can have a Schedule C business or a Schedule F business if it's a farmer, and they can set up a retirement plan for themselves, even if it's just one owner and they don't have any employees. But you can also set up a retirement plan for your employees and yourself as well. In this unit, we cover retirement plans from a business owner's perspective. And this is the way that I want you to think about it, specifically for this webinar. Don't think about it as like an employee working for someone else. Don't think about it on that side. Think about it as if you're a business owner. You're a business owner. I know many of you are. And think about it like, okay, I have 5 employees or 10 employees, and now I have to make a choice about the retirement plan that I'm going to set up for my business because I want to set up a retirement plan. Now, retirement plans are not mandatory. There is nothing in the law that says that a business ever has to set up a retirement plan for their employees. It's not like the ACA, the Affordable Care Act, where after you have 50 full-time employees, you have to offer health insurance to them. There's nothing like that with regards to retirement plans. But it's been proven and shown that businesses that do offer a retirement plan have a lot less turnover than businesses who don't. So many businesses choose to set up retirement plans for their employees because it reduces employee turnover. It encourages employees to stay. There are numerous forms of retirement plans that are available for small businesses, including simplified employee pensions. These are often just shortened to SEPs, S-E-P, SEPs. Savings incentive match plan for employees. These are simple plans. And qualified plans, which include 401k plans and traditional pensions. If retirement plans are structured and operated properly, businesses can deduct retirement contributions that they make on behalf of their employees, or if self-employed, for themselves. Both the contributions and the earnings are generally tax-free until distribution. So the earnings will grow tax-free, just like a traditional IRA, and just like a Roth. But with a Roth, the contributions are not pre-tax. They're post-tax dollars. But either way, the contributions are going to grow tax-free. Business retirement plans do have their drawbacks. Pension plans are not free to administer. And most of the retirement plans that I'm going to be talking about in this webinar are for smaller businesses, small business owners. But as the retirement plans get more complex, and as you can put more money away into those retirement plans, the costs go up. The administration costs go up. And I'm going to explain all of that. But the more money you can sock away, or the more money you can put into that retirement plan, the more administration costs you're going to have. Even very simple pension plans for small businesses can cost the employer thousands of dollars annually for administration, accounting, and insurance. In contrast, a traditional IRA or a Roth IRA will not require pension plan administrative fees. Anybody with qualifying compensation can set up a traditional IRA or a Roth. They can just go down to their local bank or their credit union and set one up there. But compared to these other retirement plans that I'm going to be talking about in this webinar, you can't put very much money into a traditional IRA or a Roth. You're limited to around $7,000 depending on your age. But like a 401k, you could potentially put tens of thousands of dollars into that 401k on a pre-tax basis. And then, of course, that's deductible to the business itself. So traditional and Roth IRAs don't require pension plan administrative fees. You can go to any bank or credit union and set one up, but you can't put as much money into those types of plans. So that's the big drawback with these. In the case of a sole proprietorship or a partnership, if the owners of the business contribute to their own retirement accounts, they may take the deduction as an adjustment to income on Schedule 1. And I want you to realize this. If it's a sole proprietor or a partner in a partnership, they're considered self-employed, right? We're talking about general partners in a partnership, not investors, like a limited partner. They're considered self-employed. So for them, it's an adjustment to income on the Schedule 1 of the Form 1040. Now, if you have employees working in the business, and you as the business owner contribute to their retirement plans, then that's an expense on the Schedule C, or it's a business expense on the Form 1065, if it's a partnership. Now, with regards to the owners of a sole proprietorship or the partners in a partnership, the business actually has to have revenues, has to have profits in order for them to make a contribution for themselves. For example, it cannot generate a loss for the business. You have to have earned income or profits on the business, showing on the Schedule C or on the Form 1065. The business has to have profits in order for the owners to actually make a contribution for themselves. However, if the business has employees, then the business can still make contributions on behalf of those employees, even if it generates a net operating loss for the year for the business. Just like with wages, right? You can pay wages to employees even if your business is losing money. And what happens is it's just considered a business expense, and it would increase your net operating loss for the year. That's not the case with C corporations, though. If you have a C corporation, the C corporation can contribute to the sole shareholder or any other employee, their retirement plans, and it's just a business expense. The C corporation doesn't have to have profits because it's not a pass-through, so it doesn't matter. But if it's a sole proprietorship or a partnership, in order for the owners to actually contribute to their own retirement plans, for example, if it's a SEP or a simple plan, then the business has to have profits if the owners want to contribute to their own retirement plans for the year. Now, here's the Schedule 1. This is page 2 of the Schedule 1. This is the adjustments to income. If someone is self-employed and has a retirement plan set up for their own business, and they contribute to their own retirement plan, then where the owner actually takes the adjustment to income is here on the Schedule 1, not on the Schedule C or the Schedule F if it's a farmer. It's line 16. As you can see, it says self-employed SEP, simple, and qualified plans. Line 16 right here. If it's a traditional IRA, it doesn't go here. It goes down here on line 20. So a different area of the form. So this is where the owners of the business would report their retirement contributions for themselves, if they have a SEP, a simple, or some other business retirement plan. Now, if you're a business owner and you have employees and you contribute to their retirement accounts, it goes on the Schedule C or the Schedule F. Now, this is a Schedule C, so if you have a sole proprietor that has employees working for the business, then where they would report the retirement plan contributions made on behalf of employees, it will go on line 19 for pension and profit sharing plans. This is not where you would report your own retirement plan contributions if you were self-employed and you were the owner of the business. This line here would be the contributions that were made to your employees' retirement plans, regardless of what type of retirement plan you set up for your business. Pension and profit sharing plans. This line down here, 14, employee benefit programs, is for insurance, like long-term care insurance, health insurance, that you provide on behalf of your employees. And then up here on line 19 is for retirement plan contributions that you make on behalf of your employees. This is not where you put your own retirement plan contributions. That would be on the Schedule 1. This line right here is just for contributions that the business owner makes to the employees' retirement plans. SEP-IRA plans. We're going to talk about SEP-IRAs first. A SEP is an IRA, and it's one of the easiest types of retirement plans that a sole proprietor or a self-employed person can set up. It's very, very easy. Most of the time, financial institutions charge you almost nothing or a very nominal fee to set these up. Sometimes it's free to set them up, depending on the financial institution. This is a SEP-IRA. It provides the simplest and least expensive method for employers to make contributions to a retirement plan for themselves and for their employees. Contributions to a SEP-IRA are treated similarly to contributions made to traditional IRAs and are subject to many of the same rules, although the contribution limits are significantly higher. So this is the big benefit that SEPs have over traditional IRAs and Roth IRAs, is that you can put a lot more money into a SEP, but it's a percentage of the profits of the business that you could put in for the owner. And if the business doesn't have any revenues, then you can't put anything into a SEP. It has to be a percentage of your profits. But you can put a lot more into a SEP than you can into a traditional IRA. An employer may establish a SEP as late as the due date, including extensions, of its income tax return and have it be effective for that year. The employer must also make its contributions to the plan by the due date, including extensions. With SEPs, there is no requirement for an official plan document like there are with the other retirement plans that I'm going to discuss in this webinar. You don't need any kind of fancy paperwork. However, if the business has employees, you have to notify the employees somehow that you're going to set up a SEP for them. So you have to execute some kind of a written document, but there's like a half-page form that the IRS actually provides for this. It's the Form 5305 SEP. This is the IRS model SEP, and this will suffice as the written agreement that you can give to all of your employees if you set up a SEP IRA for your business. This is the 5305 SEP. This is the form that you can use basically to give your employees notice that you have a SEP for your business. If you are a small business owner that sets up a SEP for your business, you usually have to set up a SEP for each employee that you have in the business, and you have to give them something. So you can give them this little half-page document. Now, I checked on the IRS website today, and this form hasn't been updated in a really long time. But you don't send this form to the IRS. You're just supposed to keep it for your records. But all of the thresholds on here are really old. These are not up to date. But I'm assuming you could like copy and paste this information and put it into Word and update the amounts if you set up a SEP. It's very easy to set one up. SEP IRA employer rules. You need to understand SEP IRAs, all of these retirement accounts that I'm going to be talking about, from the point of view of the employer. Think about it as a small business owner with a few employees or 10 employees or something like that, and they have to make this decision. They're choosing a retirement plan for their business or for themselves. There's drawbacks and benefits to each one of these. Contributions to a SEP IRA can vary from year to year, so it is a very flexible option for small employers. So this is a plus. A SEP IRA can be set up for an individual person's business, even if he or she participates in another employer's retirement plan. For example, if you have a full-time job and you have a 401k through that job, then you have a side business. You can also set up a SEP IRA for your side business. You could have both. That's fine. Under a SEP IRA, employers make contributions to an individual retirement arrangement, which must be set up for each eligible employee. Now, this is one of the drawbacks. An employee cannot opt out. If an employer decides to set up a SEP IRA for his or her business, all qualified employees also must have a SEP IRA set up for them. And this is even if you know if the employee is going to quit or go off to college or something like that. Even if you know they're leaving, you still have to set up a SEP IRA for every qualified employee. And I'm going to go over what a qualified employee is in a minute. But an employee cannot opt out. If they don't want the retirement plan, it's too bad. You still got to set it up. Contributions to a SEP are generally 100% tax deductible by the business owner, and investment earnings in a SEP grow tax deferred, just like any other IRA. Employer contributions are pre-tax and not subject to income tax until later withdrawal. Contributions to a SEP IRA are immediately 100% vested. This is actually a drawback for the employer. I want you to understand what this means. The contributions that you make to an employee's SEP IRA are 100% vested, which means it belongs to them immediately. It's not like a traditional 401k, which can have a vesting schedule, or a traditional pension, which can also have a vesting schedule, where it's like, okay, you need to be with us for a certain number of years before you have access to this money. SEP IRAs are not like that. SEP IRAs are immediately 100% vested, which means that as soon as you put the contribution into the employee's retirement account, it belongs to them. They can do whatever they want with it. They can withdraw it the next day if they want. It belongs to them immediately. This means that the SEP IRA is owned and controlled by the employee, and the employer makes contributions to the financial institution where the employee's SEP IRA is maintained. SEP IRA example. Herman works full-time for the post office as a mail carrier and also runs a profitable wedding photography business with his wife on the weekends. They have $32,000 in self-employment income from their photo business. Herman may set up a SEP IRA for himself and his wife through his photography business, even though he is already covered by a retirement plan through his job at the post office. And this is actually a fantastic tax planning device, just so you know. If you have a person who works full-time, but then they also have like a side business that they run with a spouse, it can either be a partnership, like a spousal partnership where both of them are partners in a partnership, or it can be a situation where, let's say, Herman reports that photography business, that wedding photography business, as a Schedule C business, and then he hires his wife as an employee of the business. Then he can actually fund his wife's retirement accounts as well as his own SEP IRA with the profits from the business. And this is a great tax planning device, especially as taxpayers get older. They look for ways to fund their retirement in more creative ways. And he can have a pension at his regular workplace as a mail carrier and also fund a SEP IRA for himself as well as his wife. So they can max out both of those SEP IRAs for him and for her with the self-employment income that they're making on the weekends from the photography business. Here are the rules for employees with regards to a SEP IRA. Think about this once again in terms of the employer that is setting up these plans on behalf of their employees. An eligible employee for SEP IRA purposes is one who meets all of the following requirements: is at least 21 years of age, has worked for the employer in at least 3 out of the last 5 years, has received at least $750 of compensation. This is a really low threshold for compensation. Basically, it means that if you have someone who's working for you and they're at least 21 years of age and have worked for you at least 3 out of the last 5 years, you're going to have to add them to the SEP IRA or set up a SEP IRA for them, because employees cannot opt out if they actually qualify under these requirements. An employer can use less restrictive participation requirements than those listed, but cannot use more restrictive ones. For example, an employer could choose to include all employees who are at least 18 years old rather than 21 years old. The following employees can be excluded from coverage under a SEP IRA. Employees who are already covered by a union agreement. In Publication 560, these are called collective bargaining employees. So sometimes the IRS will use either one of these terms on the exam. If it's a union employee, a person who's already covered by a union, then they don't have to be included in the SEP. You don't have to set up a SEP for them. Or if it's a non-resident alien employee who has received no U.S. source income from the employer. I can't think of any scenario where that might occur. Maybe if you had a U.S. company that also had a foreign branch, like, I don't know. I've personally never seen this, a situation where it was an employer that had a SEP IRA and had a non-resident alien employee who received no U.S. source income. But these are the two types of employees that can be excluded. The employer would not have to set up a SEP for them if they're union employees or if they're non-resident alien employees who have received no U.S. source income from the employer. Each year, an employer contributes to a SEP. It must contribute to the SEPs of all participants who had qualifying compensation. What this means is that if you have an employer and it's the owner of the business, if they contribute to their own SEP, then they have to contribute to the SEP of all the participants, basically all of their employees who are also part of that group retirement plan. So for example, let's say I have a tax preparation business and I'm filing on a Schedule C, and I have 4 other tax preparers working for me. I can set up a SEP for my business. I have to set up a SEP for all of the other employees working for me, assuming that they fit these eligibility requirements up here. They're at least 21 years of age. They've worked for me for at least 3 out of the last 5 years, and they've received at least $750 in compensation. I would have to set up a SEP IRA for them as well, if I had a SEP IRA set up for my business. And then if I contribute to my own SEP for the year, then I also have to contribute to their SEP. And the employer is the only one that makes contributions with a SEP. That's one of the big drawbacks of a SEP. And the reason why SEP IRAs are extremely popular for single owner businesses or like husband and wife businesses, spousal businesses. But many times businesses don't like SEPs once they start to grow, because the employees can't contribute to their own plans, and it's only the employer that's making the contributions. That's actually one of the drawbacks of the SEP. Currently, employees can't contribute to SEP IRAs. Only the employer can contribute to the SEP if it's a business that has employees, or if you're self-employed, you can contribute to your own SEP. Like, you don't necessarily have to have employees. You can have a Schedule C business and have a SEP IRA just for yourself. That's pretty commonplace too. I just want you to realize that in the past, we had someone in the forum ask about this, which is why I'm mentioning it now in this webinar. In the past, there used to be a different type of SEP IRA called a SAR SEP. Those were around up until the late 90s. And there are still grandfathered plans, SAR SEPs, out there. The IRS is not going to ask you about this on the exam, but it's still in the pubs. With those old plans, the SAR SEPs, employees were allowed to contribute to those plans. Back in the olden days. Back in the olden days. And some of those plans are still floating around. There's still grandfathered plans out there from the late 90s where employees could actually contribute to the SEP. They were salary reduction contributions, kind of like they do with 401ks. But those don't exist anymore. They're just grandfathered plans that still exist. If you were to set up a SEP for your business now, there would not be a SEP where you could make employee contributions. Only the employer can contribute to a SEP. But there are old plans out there that are grandfathered where employees could contribute. And I never used to mention this before, but we had a user in one of the groups that actually asked about it. So I feel like I should mention it. In the past, it was possible with certain types of SEPs called a SAR SEP, where employees could actually contribute to their own SEP and employers could contribute too. You can't set up a plan like that anymore. There are old plans that still exist, but now, as of now, if you wanted to set up a SEP IRA, then only the employer can contribute in the modern era. So the SAR SEPs haven't existed since around 1997, right around there. And there is a footnote in your book, so you know that those exist, and maybe one day somebody will step into your office that has one of those. But currently, only employers can contribute to a SEP IRA. Employees cannot contribute to their own plans. And these are the rules. Contributions and distributions. Contributions to a SEP can be made for participants of any age. Unlike traditional IRAs and 401ks, SEP IRAs do not offer any catch-up contributions. Now, I want you to understand that all of these retirement plans that I'm going to talk about are different. They're all different. They all have different rules. With a SEP, there's no catch-up provisions, which means once a person gets to be age 50 or older, they don't get to put more in. Like with a traditional IRA, if you're age 50 or older, you get to put more into the traditional IRA. You get to put in a catch-up contribution. And a SEP is technically an IRA. It's a SEP IRA. But you don't get to put in a catch-up contribution with a SEP. You don't get to put in more money once you turn age 50. Employers do not have to contribute each year, but if the employer does contribute, it must contribute an identical percentage for each eligible employee. Now, this is actually a drawback and a benefit. because with a SEP, you don't have to contribute every single year. And some of these other retirement plans that I'm going to talk about, the employers are required to contribute every year. They have to contribute something. With a SEP, you don't have to contribute every year if you're the employer, the owner of the business. But if you want to contribute to your own SEP, you're going to have to contribute to the employees' plans as well. You can't choose to contribute to your own plan and not contribute to the employees' plans. Participants cannot take loans from SEP IRAs. You're not permitted to take a loan from a SEP. You cannot take a loan from a SEP IRA, but there are some types of plans that do permit participant loans, like 401ks will permit a participant loan, but you can't take a loan from a SEP IRA. However, participants can make withdrawals at any time. Withdrawals can also be rolled over tax-free into another SEP IRA, to another traditional IRA, or to another qualified retirement plan. So for example, if you have a SEP IRA at the employer that you're working at now, and then you quit and you start working for another business, as an employee, then the SEP IRA belongs to you as the employee. It moves with you. You can roll it over into another plan. That's fine. And you can also take withdrawals at any time, because all of the money in the SEP IRA belongs to the participant of that SEP IRA. It's immediately vested, which means once the employer puts that money into the SEP IRA, it belongs to the participant. It belongs to the employee. However, if an employee withdraws money from a SEP IRA before age 59 and a half, a 10% additional penalty may apply unless the taxpayer qualifies for an exception. I do have a link in your slides that shows you where you can find the penalty exceptions to that 10% penalty tax on the IRS website. This chart I just recently found on the IRS website. If you want to look for the exceptions to tax on early distributions when a taxpayer actually withdraws money from their IRA or from another retirement account, and they do it early, they do it before they're 59 and a half. The penalty exceptions are not the same for all types of retirement plans. And that's one thing that trips people up when they're newer preparers. The penalty exceptions are not the same for 401ks, like qualified plans, as they are for IRAs, SEPs, and simple IRAs. Some of them are similar. Like, for example, if you have a death, if the participant dies, like the owner of the IRA dies, whether it's an IRA or whether it's a 401k, that's a penalty exception for all types of retirement plans. If the participant dies and then the retirement plan actually passes to an heir or a beneficiary, then there's not going to be any penalty, regardless of the age of that beneficiary, the person who actually inherits the IRA after the death of the participant. But some of these other exceptions to the 10% tax are going to be different based on the type of retirement plan that it is. For example, as you can see right here, if it's qualified higher education expenses, like if you pull money out of your retirement plan for college, if it's an IRA, that is a penalty exception. But if it's something like a 401k or a qualified plan, that's not a penalty exception. And sometimes that'll trip up newer preparers because they assume that the penalty exceptions are all the same, and they're not. There's a link to this chart in your slides. I suggest maybe bookmarking this. This is like a spreadsheet. I suggest maybe even copying and pasting this spreadsheet into Excel so you can kind of have it or print it out. It gives you the code section, and then it also tells you whether the distribution qualifies for an exception. So I do recommend bookmarking this page, not just for the exam, but also for your own knowledge. It can help you if you have a client that comes into your office and they do have an early withdrawal. You can use this as a quick reference to see if they will qualify for a penalty exception. Many times, taxpayers won't know this information themselves, and their 1099-R will say that no penalty exception applies, but this is something that you can actually override in your software pretty easily if you look on here and they actually do qualify for a penalty exception. I had 2 clients this tax season that had early withdrawals from their retirement accounts, and on the 1099-R, it had the code of 1, which means no exception applies, but I was able to find out by asking them questions that they were in a FEMA disaster area. Their county was affected by a FEMA disaster, and both of them had flooding. It was in California, and both of them were affected by a FEMA disaster, and I was able to get a penalty exception for both of them, which allowed them to avoid that 10% additional tax. They were IRA accounts, So they still had to pay income tax on the withdrawal, but they avoided the 10% additional penalty on the withdrawal because both of them had a disaster exception right here. Federally up to $22,000 to qualified individuals who sustain an economic loss by reason of a federally declared disaster area where they live. They were able to avoid the penalty in that case. This chart is very useful, especially if you have a client that has an early withdrawal from one of their retirement accounts. And here's a little spreadsheet for the rules for a SEP IRA. I suggest, like putting this information on a flashcard because each one of the retirement accounts that I'm going to be talking about are different. The SEP IRA has different rules than a simple plan. It has different rules from a 401k. It has different rules from a qualified plan. So you have to know what the eligibility requirements are, the pros and the cons and the drawbacks that apply to SEP IRAs, that apply to simple plans, and that apply to qualified plans, because they're all going to be different.
Simple plans.
Simple plans. Now, simple stands for savings, incentive, match, plan for employees. A simple plan. These are for small to medium employers only. Like SEPs, simple plans have lower startup and annual costs than most other types of retirement plans. Now, a simple plan can be structured in one of two ways. There's two types of simple plans, and the employer gets to choose which one they want. Either a simple IRA or a simple 401k. They can choose either the IRA or the 401k. Now, there's rules that apply to both of these types, and there's also rules that apply to one or the other, one and not the other. These are different. These are different types of retirement plans. However, for both of these types of retirement plans, it has to be a business that has 100 or fewer employees. Once the business goes over 100 employees, it can't have a simple anymore. So it's just for small or mid-sized businesses. A simple IRA must be set up for each eligible employees, just like a SEP IRA. Eligible employees cannot decline. You have to set up a simple plan for them if they're a qualifying employee. And I'm going to go over what a qualifying employee is for a simple because it's a little bit different than for a SEP. The thresholds for the wages is higher. So more employees can actually be excluded from the simple if they're just like seasonal or part-time. The business cannot maintain another retirement plan unless the other plan is specifically for a union workforce. The business must continue to meet the 100 employee limit every single year. Every single year, the employer has to have 100 or fewer employees. Once it goes above 100 employees, 101 or more, it has to transition to another retirement plan. Now, it doesn't have to do this right away. The IRS actually allows the business to have a 2-year grace period. So the business can have a 2-year grace period to basically transition its employees into another retirement plan, and they can continue to maintain the simple plan during that grace period. But they have to make a switch at that point once they have more than 100 employees. Now, a simple IRA is less burdensome for the employer than other types of retirement plans. The employer has no requirement to make annual filings to the IRS. With a simple IRA, the employer doesn't have to file a Form 5500, which is an information return for the retirement plan itself. As we get into more complex retirement plans, the retirement plans actually have an annual filing requirement, which is the Form 5500. A simple IRA doesn't need to file one of those. Unlike a SEP IRA, which is the one that we just talked about, employees may contribute to their own simple IRA. So this is considered a benefit. That means that the employees can fund their own retirement with pre-tax dollars, and the employer can also put money into the simple IRA on behalf of the employee as well. Contributions to each employee's simple IRA are made up of their own salary reduction contributions and employer contributions. So unlike the SEP IRA, the employer and the employee can fund the simple IRA. So it's different in that regard. This is a more beneficial retirement plan for both the employer and the employee. And it's more popular as businesses get a little bit larger. So the SEP IRA is more popular for very small businesses. I mean, like less than 5 employees, or where it's just a solo practitioner with a Schedule C. That's where the SEP is popular. The simple IRA is more popular for like mid-sized businesses that have fewer than 100 employees, but still want like a retirement plan that's a little bit more robust. With a simple IRA, each year the employer must choose to make either a matching contribution or a non-elective contribution to the employee's retirement plan. So this is different than the SEP. The employer has two choices in this case. They can make a matching contribution where it's a dollar for dollar match on payroll contributions up to 3% of compensation. This percentage can be reduced as low as 1% in any 2 out of 5 years. So this offers a little bit more flexibility to the employer if they have like a bad year in there. They can reduce the matching contribution to as low as 1% if the business does poorly in 1 year. But they can only do this in 2 out of every 5 years. They can't reduce it to 1% all the time. It can be 1% in any 2 out of 5 years if they choose to do the matching contribution. Now, the employer can also choose to do non-elective contributions. They have to choose one of these. The non-elective contribution is where the business can choose to contribute just a flat 2% of each eligible employee's compensation. They can do either or. An employee may choose not to make any salary reduction contributions for any given year. The employee themselves, they don't have to fund their simple IRA if they don't want to. If they're eligible employees, the business still has to set up a simple IRA for them. If they're qualifying employees, they still have to have a simple IRA. But the employer can't force the employee to fund their own simple IRA. The employee doesn't have to put money into their simple IRA if they don't want to. Simple IRA examples. Jones Creamery, Inc. is a dairy processing business with 30 employees, so like a mid-sized business. The business has a simple IRA plan for its employees. Jones Creamery generally makes matching contributions of 3% of the employee's compensation. However, this year the business does poorly and revenues are down for the year. Jones Creamery can reduce its matching contribution percentage to as low as 1% in order to conserve cash. This flexibility can help a business conserve cash flows in years when a business has significant drops in revenues. So there's a little bit of flexibility here for the business, which is nice. Example number 2. Berry Ranch, Inc. is a farming corporation with 50 employees. Berry Ranch decides to establish a simple IRA plan for all of its employees and will match its employees' contributions dollar for dollar up to 3% of each employee's salary. So, for example, an employee can actually choose to contribute more of their salary up until the annual limit. You might have an employee that's contributing 5% or even 10% of their salary up until the simple plan limit. They can contribute, but the employer is going to match only a certain percentage of that. So in this case, the employer is doing a dollar for dollar match of up to 3% of each employee's salary. Martha works as a full-time bookkeeper for Berry Ranch. She has a yearly salary of $50,000. So these are her wages. This is the employee's wages. And she decides to contribute 5% of her salary to her simple IRA. Martha's yearly contribution is $2,500. That's 5% of $50,000. This is her wages. Berry Ranch's matching contribution is $1,500. That's 3% of $50,000. So they're matching her contribution up to 3%. Therefore, Therefore, the total contribution to Martha's simple IRA for the year is $4,000. This is her contribution, which is pre-tax, and the $1,500 contribution from her employer. You see how that works? Okay. Simple IRA setup deadline. An employer can set up a simple IRA plan effective on
Simple plans.
contribution of 2% to each pay. Now note, unlike the simple IRA for larger employers, 401k plan is easier and it's cheaper for employers to offer. A simple 401k offers some features of both plans. So remember, business is a brand new business and actually have until October 1st. They have to go to that financial institution, Charles Schwab or Fidelity or wherever they want to have the simple IRA for their business, and they have to set it up by October 1st. That's the deadline, normally. There is one exception to this deadline, and that's if the business is a brand new business and actually came into existence or was formed after October 1st. Then the business actually is allowed to set up a simple IRA later than October 1st. Simple 401k plans. So remember, with a simple, you can either choose the IRA, the simple IRA, or the simple 401k. You still have to have less than 100 employees, but the business can choose either one of these, the simple IRA or the simple 401k. A subset of the 401k plan is the simple 401k plan. The simple 401k plan is a combination of a simple IRA and a traditional 401k. A traditional 401k requires non-discrimination testing, and it also has higher contribution limits, but it also costs a lot more to set up and administer. A simple 401k plan is easier and it's cheaper for employers to offer. A simple 401k offers some features of both plans. Unlike a traditional 401k plan, a simple 401k does not require annual non-discrimination testing, which is expensive for larger employers. Since non-discrimination testing can be very expensive for the employer, this makes the simple 401k appealing to a small business owner who likes the features of a traditional 401k, but cannot afford the administration costs of non-discrimination testing. The contribution rules are a little bit different for a 401k. The employer is required to make either a matching contribution up to 3% of each employee's pay or a non-elective contribution of 2% of each eligible employee's pay. Now note, unlike the simple IRA, the option to reduce matching contributions down to 1% is not available with the simple 401k. With a simple IRA, you could potentially reduce the employer contributions. These are the employer contributions, the money that the employer is putting into the employee's retirement accounts. You could reduce it down to 1% for the years that the business doesn't do as well with a simple IRA. You cannot do that with a simple 401k. So with a simple 401k, the employer has fewer choices. It's either a matching contribution up to 3% or a non-elective contribution of 2% to each eligible employee's pay. Now, with a simple 401k, employees are totally vested in any and all contributions. This is the same as the simple IRA. This means that the employee can withdraw from their simple 401k at any time. Okay, there's going to be penalties many times if the employee is not retirement age yet, but they have control over the funds. Once the money goes in, it belongs to them, so there's no vesting schedules. It's immediately vested, all of the employer contributions. Unlike an IRA, participant loans are allowed from a simple 401k plan. 401ks can allow participant loans. You can take a loan from a 401k, which is different than a distribution. When you take a distribution from a retirement account, a distribution is taxable unless you roll it over into another retirement account. But with a 401k, you can take a loan from a 401k. You can never take a loan from an IRA, ever. It doesn't matter what kind of IRA it is. Whether it's a traditional IRA or a simple IRA or a SEP IRA, you cannot ever take a loan from an IRA, from an individual retirement account. But 401ks can offer loans. The employer can choose to do this if they want. It's not mandatory. I want you to understand that. A simple 401k does not have to offer loans, but many times employers like the option of offering participant loans because employees like that. They like to be able to take loans if they need money for like a short period. Let's say I need money for like 6 months or for a year or just to buy a house or whatever, but I want to pay it back, but I don't want to actually recognize the income. Then that's what a loan is for. That's what a loan is good for. So you can take a loan from a simple 401k or a traditional 401k, but you can never take a loan from an IRA, which is why some employers choose to have the simple 401k instead of the simple IRA, because you can offer participant loans and you can never offer a loan from an IRA. In order to establish a simple 401k plan, the business must have 100 or fewer employees. Once you have 101 or more, then you can no longer offer a simple IRA or a simple 401k, and you have 2 years to get another retirement plan for your business. So it has to be 100 or fewer employees. You cannot have any other retirement plans. And then this is the big drawback of simple 401ks versus simple IRAs, is that you have to file a Form 5500 annually. So a simple 401k has an annual filing requirement. The plan itself has to file an information return, the Form 5500, every single year. A simple IRA doesn't have to do this. So this is a drawback of the simple 401k. There are some notable differences between traditional 401ks and simple 401ks. Unlike a traditional 401k, employee contributions to a simple 401k are fully vested. This is good for the employee, but not good for the employer offering the plan. With a traditional 401k, employer contributions can be subject to a vesting schedule, and this may help reduce employee turnover. And I've read some studies on this. For example, if you have an employer that has a vesting schedule with a traditional 401k, a traditional 401k can have a vesting schedule. Like, okay, so you're not going to be fully vested in your retirement account until you've been with the company for at least 5 years. That can reduce employee turnover up to like 50% because the employees want that money, so they stay. And that's one of the main benefits of a vesting schedule. But with a simple 401k, you can't have a vesting schedule like you can with the traditional 401k. All of the employer contributions and the employee contributions, obviously, are totally vested. So as soon as the money goes into their account, the employee has control over it and they can withdraw it or roll it over into another retirement plan at any time. The other drawback to a simple 401k is that contribution limits for a simple 401k plan are lower than the limits for a traditional 401k plan. So a simple 401k plan is cheaper and it's easier for the employer to set up. It doesn't require non-discrimination testing, which is expensive. But a traditional 401k allows people to fund their retirement more. The contribution limits are higher. And then a traditional 401k also will allow a vesting schedule. So obviously there's pros and cons that you have to consider as a business owner here. You want cheaper or you want to fund your retirement account with more money and have a vesting schedule. So it can be a tough decision when you have so many different options out there with retirement plans for businesses. You have to decide. Now, simple plans cannot be terminated in the middle of the year, either simple IRAs or simple 401ks. A business can't just say, oh, we don't have the money to do this anymore. We're just going to terminate the plan. You can't do that. They can only be terminated at year end and only if the employer gives timely written notice to all of its employees. To terminate a simple plan effective the following year, an employee must notify its employees prior to November 2nd. So by November 1st, okay? So to start one of these plans, it has to be by October 1st. To terminate one of these plans, you have to notify all of the employees by November 1st of that year. Employers do not need to notify the IRS that they're terminating the simple plan, but they are required to notify all of the employees. Qualified retirement plans. Qualified retirement plans. Now, qualified retirement plans are not like the ones that I've just been discussing. There's two types of retirement plans that are considered qualified plans. These are defined contribution plans, like a traditional 401k. These plans require the employee to fund their retirement account with their own money. And then there's defined benefit plans. These are also referred to as traditional pensions or pension plans. A defined benefit plan is a type of retirement account for which the employer invests all the money and promises a set payout when the employee retires. Federal government workers get these, police officers, postal workers. My dad has one because he was a teacher for a really long time in California. So he has what's considered a traditional pension. And the employer is the one that funds those pensions and basically promises a set payout until the employee dies. But these are very expensive to administer and maintain, and for that reason, they've become uncommon, except for those who work in government or public service. So you don't see these very much anymore. They used to be really common in the 50s, the 60s, and even the 70s, where, like every large employer would offer a traditional pension, but not so anymore. Private employers have moved almost exclusively to defined contribution plans like traditional 401ks, and defined benefit plans now, for the most part, are just offered, to people who work in public service, like teachers or government workers. ERISA. This is the big difference between these smaller retirement plans and then qualified plans. All qualified plans are subject to federal regulation under the Employee Retirement Income Security Act, which is ERISA. The federal government does not require an employer to establish a retirement plan. No employer is required to do it. You don't have to establish a retirement plan for your workers. But if you do, ERISA is the law that provides minimum federal standards for the plans. ERISA covers qualified retirement plans as well as health and welfare benefit plans. Among other requirements, ERISA specifies that individuals who manage those plans and other fiduciaries meet certain standards of conduct. The law also contains detailed provisions for reporting to the government and for disclosure to participants. Further, there are provisions aimed at ensuring plan funds are protected and participants actually receive their benefits. ERISA maintains minimum funding requirements to ensure that benefits will be available to employees when they retire. For defined benefit plans, it requires that plan funding be certified by an actuary. So, of course, this is going to add more administrative costs to these types of plans. ERISA also mandates that qualified plans meet specific requirements regarding eligibility, vesting, and communications with participants. They're very strict about this. The administrator of an employee benefit plan subject to ERISA must file an information return for the plan every year. This is the Form 5500 Annual Return Report of Employee Benefit Plan. And it must be filed by the last day of the 7th month after the plan year ends. And we're going to talk a little bit more about the Form 5500 and the Form 5500 EZ, because it's possible that you'll never actually prepare one of these during your practice career. This is considered a specialty, and not very many tax practitioners actually do these, but you have to know about it for the test. Now let's talk about the 5500. The 5500 is the annual information return for a retirement plan. The due date is the last day of the 7th month after the plan year ends. It's not the 15th. It's the last day of the month. It's kind of an odd due date. For a calendar year plan, that would mean that the due date would be July 31st, if it's a calendar year plan. Now, we're not talking about the tax year of the business itself. We're talking about the tax year for the plan. This is commonly referred to as the plan year. So we're not talking about the fiscal year or the calendar year of the business that's actually sponsoring the plan. The plan itself actually has its own tax year. And the Form 5500 is due the last day of the 7th month after the plan year ends. So this would be July 31st if it's a calendar year retirement plan. There is a 5500 EZ that's available. It's only 2 pages, so this is a much simpler form. It's available for very small plans, and usually this is like a spousal business or a single owner, like solo 401k. So this would be limited to owners or partners and their spouses. A plan typically will be required to file Form 5500 EZ when the plan assets exceed $250,000. And I have a link here to the IRS website where they talk just about the 5500. It's called the Form 5500 Corner. So this link on the IRS website is all about the Form 5500 and the filing requirements that apply to retirement plans. As you can see, if you scroll down here, it talks about the penalties for failure to file these retirement plan returns. These are not income tax returns. These are information returns only. But like I said, the penalties are crazy. If you can look right here, the penalty for failure to file the Form 5500 series increased to $250 per day, not to exceed $150,000. That seems crazy to me. And with larger plans, these penalties can be even higher. So if the plan actually does have a filing requirement, if it has to file a 5500, it really needs to make sure that it files this return annually and it files this return on time. And this is what the Form 5500 EZ looks like. This is just a 2-page form. So it's a simple form for smaller plans to fill out, but it's only for very small employers. As you can see right here, it says annual return of a one-participant retirement plan for owners and partners and their spouses. So once a business has multiple employees working for the business, it can't use the 5500 EZ anymore, and it has to file the long form, which is a little bit more involved. Example, Form 5500. Harold is a financial planner that owns Superb Financial Inc. and S Corporation. The only other employee of the business is his wife, Karen, who works as his full-time office manager. Harold's business has a 401k that covers only him and his wife. The assets in the company's 401k plan are $275,000. So these are their contributions as well as the earnings in their retirement accounts. Harold is required to file a Form 5500 EZ for the retirement plan. He must file the return on the last day of the 7th month after his plan year ends. Their company 401k is a calendar year plan, so the 5500 EZ is due by July 31st. Defined contribution plans. Now, these are considered qualified plans. They're covered by ERISA, and there's very strict rules that the employer has to follow with regards to these plans. Defined contribution plans provide an individual account for each participant of the plan. Examples of defined contribution plans include 401ks, 403bs, and 457 plans. The participant, which is the employee, the employer, or sometimes both, may contribute to the individual participant accounts. The value of the account will fluctuate due to the changes in the value of investments that have been made with the amounts contributed. So you put money into your 401k, right? And that money is invested. Let's say it's invested in the stock market. It can go up or down, right? If the 401k is invested in stocks that don't do well during the year, the money or the investment in your 401k plan can go down. It can drop for the year. The most common type of defined contribution plan is a traditional 401k. This is the most popular type of defined contribution plan. And many private employers, both large and small, will choose a traditional 401k plan for their business. Many financial institutions administer 401k plans, which can lessen the administrative burden on individual employers of establishing and maintaining these plans. All of the large financial institutions will offer these, like Charles Schwab, Fidelity, and most of the larger banks like Wells Fargo and Bank of America. They will offer retirement plans for businesses as an option. Now, the last one we're going to talk about is a defined benefit plan. This is also called a traditional pension. Contributions to a defined benefit plan for self-employed taxpayers are limited to 100% of compensation. If a self-employed taxpayer does not have any taxable business income for the year, no contribution can be made. Most of the time, self-employed people do not set these up because they cost money to set up. For example, Charles Schwab, who I looked up just before I did this video, offers all of these different types of plans. But a defined benefit plan costs more than $2,000 to set up initially. So it does cost money to actually set up and administer these plans, even if it's just a solo plan. However, the big benefit with a defined benefit plan is that you can sock huge amounts of money into one of these plans. The limitation on the annual benefit under a defined benefit plan in 2023, i.e. a traditional pension, is the lower of $265,000 or the average compensation of the employee in the 3 highest years. No other retirement plan has an annual benefit as high as this. There's no other type of retirement plan that can permit a benefit this high. Usually, defined benefit plans are 100% funded by the employer and generally do not require employee contributions. Now, obviously, if it's a self-employed person that wants to set one of these up, then they're the ones who are going to be funding their own retirement plan. Defined benefit plans are the most expensive to administer and maintain. However, sometimes defined benefit plans are used by very high net worth individuals to legally shelter large amounts of income from tax. And a good example of this might be a professional actor or a famous musician or like a famous author, where maybe they don't have employees working for them, but they have a lot of money coming in. Sometimes they'll even have millions of dollars of income, but maybe no other employees. So they want to set up a defined benefit plan for themselves, and that's legal. They can do it. Defined benefit plans also have the benefit of protection from creditors, even in the event of bankruptcy in certain circumstances. And traditional IRAs actually don't have this protection. They don't have the same legal protections that a defined benefit plan has. With regards to defined benefit plans, they have the benefit of protection from creditors, even in the event of bankruptcy. So you could file for personal bankruptcy, and even your business could file for bankruptcy, and they can't touch the amounts that are in your defined benefit plan, your pension. So this type of plan is the most costly to set up. It's the most costly to administer. They have to file a Form 5500 every year if you do set one of these up. So they have an annual reporting requirement. But these plans allow the largest contributions, and they also have protection from creditors. The best protection from creditors is a defined benefit plan. The next unit in the book is Unit 19, where we cover trusts and estates.